Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of the sometimes crazy world of corporate finance and filings. And their latest report certainly gives us a lot to chew on. It looks like QDM International Inc is getting ready for a big move, and their latest filing with the CC is laying all the cards on the table. So let's dive in and see what is really going on before we dive. Dive deep into QDM International Incorporated's financial story. If you are new here, hit that subscribe button for regular dives into corporate filings. And if you love these deep dives and want to chat with us and other finance enthusiasts, check out our Discord community linked in the description below. Alright, so QDM International Incorporated, like many companies these days, is filing an S-1020, a formal amendment to their original registration statement with the US Securities and Exchange Commission. The date is the 17th of December 2025. And this is amendment number 5, which tells us they have been refining this filing multiple times, trying to get all the details just right. This filing is essentially their road map for becoming a publicly traded company on Nasdaq, hoping to move from the OTC market, a place where smaller companies often start. The big story here is an offering of 1,250,000 shares of common stock. They are tentatively pricing these between $4 and $5. A share, this is an important detail because the current market price of their stock on the OTCQB is much higher, around $39.32. Per share, this significant difference between the current trading price and the proposed offering price tells us the company and the underwriters are anticipating a change, or perhaps want to set a new baseline for future trading on Nasdaq. This is not uncommon for companies upgrading to a major exchange. Now here's where things get interesting. QDM International Incorporated is actually a Florida holding company. What does that mean? Well, it is essentially a parent company that owns other companies, but their actual business operations are happening far away in Hong Kong. They indirectly own all the rights to their operating business in Hong Kong. This structure is quite common for international companies wanting to access US markets, but it also means investors aren't buying into the Hong Kong business directly, they are buying into the Florida parent company. Speaking of influence, the filing makes it very clear that their CEO, President and Chairman Hui He-jung has enormous control over the company. Even after this offering, he will still hold about 99% of the company's voting power. This is a massive concentration of power, and something investors should definitely pay attention to. It means his decisions can heavily influence the company's direction and potentially how other shareholders' interests are considered. Regarding operations in China, the company says they have no subsidiaries there and no business operations there. Their business is all in Hong Kong, a special administrative region of China, but still distinct from mainland China. However, they acknowledge the risks associated with being based in Hong Kong given the current climate and potential actions by the Chinese government. This is a ring theme throughout the filing that the geopolitical landscape, particularly between China and the US, can impact their business. There is also a mention of the Holding Foreign Companies Accountable Act. The HFCA Act is a US law that can lead to US stock exchanges banning companies if their audits cannot be inspected by the US Public Company Accounting Oversight Board for 3 consecutive years. The filing explains that their current auditor is US-based and has been inspected, but they acknowledge that future changes or determinations could create regulatory risks. This is a significant piece of the puzzle for any company with significant international operations looking to list in the US. Their corporate structure is also outlined. They hold their Hong Kong operations through a subsidiary in the British Virgin Islands, and then another one in Hong Kong. This kind of layered structure is common for various financial and legal reasons, but it often means funds move through several entities before reaching the main holding company. Let's look at how the stock has been doing, if you can call it that. Their common stock is currently traded on the OTCQB under the ticker symbol QDMI. The price history shown in the filing is quite volatile, with prices jumping from $3.4 to over $159 at one point. This kind of movement is very typical for stocks traded on the OTC market and highlights the limit liquidity and potential for price manipulation. You can see some wild swings here from $3.4 to $91.8 to then $159 and back down to $34, all within a couple of years. This definitely underscores the very speculative nature of trading these types of stocks. Now for the numbers, the really juicy part, let's look at their financial performance. The filing shows that for the 6 months ended the 30th of September 2025, their net income was about $1.1 million. This is an increase compared to the same period in the previous year, which was around $948,000. So on the surface, things look like they are improving. And revenue has seen a massive jump from about $2 million in the 6 months ending the 30th of September 2024 to over $7.5 million a year later. That is a nearly 300% increase reported. They attribute this to expanding partnerships and an increase in policies. Sold, this is a very strong top line growth number. But hold on a second, all that revenue growth came at a cost. Literally, their cost of sales increased by an astronomical amount, more than 1800%. This is largely due to higher referral fees paid out. The company admits that to stay competitive and secure partnerships, they agreed to pay referral fees up to about 90% of the commission received. That means for every dollar of commission they earn, they're paying out nearly $1 to referrers. This is a huge red flag for profit margins. And the impact is obvious. Their gross profit margin actually decreased by nearly 60%. This means that even though they are selling a lot more, their profitability on each sale is significantly worse. This is not a good trend. A company should be looking to improve its gross profit margin, not see it crash, especially with such strong revenue growth. Their general and administrative expenses also went up by about 37%, mostly due to hiring more people and increased professional fees. This is somewhat expected as a company grows and prepares for a major exchange listing. Looking at their equity structure, the company has authorized a massive 700 million shares of common stock and 30 million of preferred stock. As of the 31st of March 2025, they had around 291 million shares of common stock outstanding, which later became about 8.5 million after a 1 for -34 reverse stock split. This reverse split is a common strategy to make the stock price appear higher on paper and meet Nasdaq's minimum price requirements. Their total liabilities are around $1.8 million, which seems manageable relative to their assets, but remember those revenue numbers and cost of sales issues. A significant decrease in cost of sales for the year ended the 31st of March 2025 due to lower referral fees aligns better with their reported revenue growth. This signals some positive changes in their ION structure that are not fully reflected in the mid-year numbers. As for cash, they ended the 31st of March 2025 with over $8.5 million in cash and cash equivalents, which increased to over $12.5 million by the 30th of September 2025. This looks healthy and suggests they have enough liquidity to operate and pursue their growth strategies. Now, the risk factors, a section that is always crucial to read carefully. The document flags significant risks related to their business in Hong Kong, including political instability and changes in PRC government policies. There are also risks related to relying heavily on a few insurance company partners and the misconduct of their sales representatives, the dependence on these few partners is especially concerning, as around 68% of their commissions come from just one company in 2025. Remember that massive ownership by Hui Hijung? Well, the risk section elaborates on this. His substantial influence could mean his interests don't always align with other shareholders, and he might be able to steer the company in directions that aren't beneficial to everyone. Looking at the consolidated balance sheets as of the 31st of March 2025 and 2024, we see a company that has grown its assets considerably, mainly driven by increases in cash and accounts receivable. Their equity has also grown thanks to an increase in additional paid in capital. The statements of operations highlight a very strong revenue increase in 2025 compared to 2024, driven by their insurance brokerage services and a new referral business segment. However, the cost of sales for 2024 was extremely high relative to revenue, which was significantly reduced in 2025 due to regulatory changes affecting referral fee, as this shows a positive shift in their cost structure. The cash flow statements show that operating activities generated a lot more cash in 2025 compared to 2024. This is a good sign, indicating improved cash generation from their core business. Investing activities were minimal, while financing activities showed a repayment to related parties in 2025. The notes to the financial statements are where they break down the accounting policies. First off, their revenue recognition follows the standard US GAAP model, where revenue from brokerage services is recognized when the insurance contract becomes effective. After the cooling off period, the referral business revenue is recognized when the trust company confirms the purchase and funds are received. A key detail here is that their Hong Kong subsidiary Yata must maintain certain minimum share capital and net asset levels to keep its insurance broker license. They appear to be compliant with these requirements. The offering itself is significant. They are offering 1.25 million shares, and if the underwriters exercise their option, that figure goes up to about 1.4 million shares. The net proceeds are estimated to be around $4.4 million, which they plan to use for expanding services, marketing, hiring, and general corporate purposes. So what is the verdict on QDM International Incorporated? Well, they are certainly in a growth phase with a massive increase in revenue and a significant improvement in their cost structure thanks to regulatory changes. This is a big positive, and their cash position looks solid. The biggest concerns are the extreme concentration of influence with their CEO and the inherent risks of operating in Hong Kong given the geopolitical landscape. The fact that they are upgrading to Nasdaq is a positive signal, but the significant discount to their current OTC price suggests market skepticism or a strategic move to reset expectations overall. QDM International Incorporated appears to be a high-growth company, but with significant risks attached. The key will be how they manage their revenue streams to be more profitable, rather than just chasing top line growth, and how they navigate the complex regulatory and geopolitical environment they operate in. We will be watching them closely. Alright, that is our deep dive into QDM International Incorporated's latest SEC filing. What do you think about their strategy and the risks involved? Let us know your thoughts in the comments below. If this analysis was helpful, give us a thumbs up and subscribe for more from Corporate Decoder, and remember to join our Discord community, linked in the description for more in-depth discussions. Thanks for watching, and we'll see you in the next one.